What's going on, guys? It's Josh again, and today I'm going to talk about how to predict the movement of a stock. Now, I'm not going to lie, this is kind of clickbaity because we're not going to say how to predict it, but how to read the market. There is actually a prediction that the market price tells you. So, you could consider it clickbait. It's really not. It's just you have to kind of have a deeper meaning. But before I get into that, make sure you guys subscribe, turn on the notifications so you don't miss any videos, and also check out the free stock trading course below. It says $1. You sign up, you join the chat. All you have to do is post on your social media a thumbs up picture that you just got in the course that you're learning, and you'll get your dollar refunded. So it is free. I'm not going to accept Instagram story posts anymore. I want you guys to actually post physical actual Instagram and Facebook posts. So there's that. But let's get into this, because I posted in that video where the $60 to 1700, and people were asking when I said Facebook options were only pricing in a 5% move, how do you read that? And this is how you can see what the predicted. So it's not how to predict, but it's how to read what the market is predicting. And now you might say, how does the market do that? It's by based at the current price you're paying for an option, there's a break even. And now I have the video, the biggest mistake options traders make, and that's what I talk about is understanding the break even price. But where you need to understand this with options to see, especially for earnings moves and even in general, is what they're saying. The option going for a specific price, it is making an implicit or implied, that's where implied volatility comes from. It's implying a certain statement about where the stock is going to go. That's why it is for sale at that price. So we're going to look at Amazon earnings. They just reported, and it's actually it's scary how spot on this is. And that's where you guys got to think the Black-Scholes model, the options pricing that these, all these algorithms and these banks and all of them that are employing, they're doing it to protect themselves and make money. And there's people selling options, and that's how they go about it. So what you want to look at is, and now it's kind of weird, we'll do this on a different stock that hasn't moved, but I'll show you with earnings first, is you want to go to the strike price that is at the money. And now here's the thing you also have to do. You have to watch out for the date on the contract, because now I'm looking at July 27th. So whatever interpretation I'm going to give, it's giving us the expected move by the end of this date, because they're charging for the contract how much money to buy the right, or to buy or sell this option or this stock by the end date. So that's why, this move we're going to be seeing is implying by the end of July 27th. So if I went over to August, it would say the expected move, or what it's predicting the stock, the implied move by August. So for here, we see, let me turn on my crosshairs like I'm playing Call of Duty. All right. So we'll make it a little bigger. Here you guys see the stock closed at 1804. I think it was actually 1808, 1810. If I turned off extended hours. Yeah, 1808. That seems to be the closing price. So 1808, let's go down here. Which one's closest to the money? We could either do the 1808 or the 1807. This one might be closer. It's 50 cents out of the money. Or this one's about $2. I think we're going to use this one because this one has a very big spread. Or the last trade went for 50, but this one has a tighter spread, I think. This one's a $3 spread versus 49.50. I think they're about the same, actually. I'll use the 1810, but really you want to go to the strike price closest to the money. So here's the call, here's the put. So for the put, it's going for $53. So it's already $2 in the money. So remove that from the strike price here, right? We're going to say, because it was already $2 in the money. So what we have to do now is subtract that $2 from where 810 is, or from the ask price. Excuse me, I'm getting a little jumbled. I got a phone call. But so take $2 off because it's $2 already in the money. If the stock is at 1808 and the put is for 1810, your put would be $2 in the money. So subtract $2 from the ask, you get 51.20 or about 52.10. So we'll use 51.20. So that means you're spending your break even, essentially, for you just to break even on this stock. The stock has to go down. At this case, the price is going to be, your break even is 53.20, but now you already know it's $2 in the money. But essentially, it's predicting that the stock is going to move $51 down. So again, even if we did 1810 minus 5320, your break even is 1756. That is where they're expecting on the downside the stock to go, right? So now in this case, the implied move is $57 down, but now let's also look at the upside. So now this case, it'd be reversed because this one's out of the money. So let's go in the money. You're 50 cents in the money. So you would pretty much take away 50 cents from this. But now take a look, 1807 plus, oh shit, 1807.50 plus 53.35. If you bought it at the ask, your break even, you would get 1860. And sure enough, where did the stock go today? It closed at 1867 after earnings. So you guys are like, whoa, how did that happen? It's not anything crazy. It's just the numbers, all of these prices have a meaning. And that's where it comes into interpreting an option chain. This is partly how I use my strategy to find these mispriced options. But again, you guys got to be careful because it's not always right. But again, going back to that Facebook example, I was able to price in, I didn't price it in. I saw that the market was pricing in a 5% move by the end date. And then I figured, a 10% move based on the fact that since April, Facebook moved up over that 30%. And then the fact that it hasn't had a bigger earnings surprise, that's part of where this data is coming from. The market is just averaging over time. Black-Scholes model is taking the daily movement, the average velocity of how it's moving, and then the average earnings results and where it moves, and that's how they're coming up with it. So that's why you see a lot of the times when the option prices get high and you're paying into earnings, most of the time you're going to lose money because you're paying for this implied move. And if you fall anywhere on that's why anybody out of the money, you're really getting killed. Anybody out of here, you got murdered. And even then, even if you bought this right here for 260, $25, you would literally imply that move now this one's easy to add. It just literally add $25. So you're at 1885. Come tomorrow, it's not going to be at 1885. These contracts are going to go down in value. They're going to go to $7 in value because it's only $7 in the money. So that's something you got to account for, and that's what you got to be careful for. So now let's do it now on a company that's going to report here soon. We could do Twitter. I like that. I haven't made a play on it yet. I'm going to look into it, and this is the process I would do. I would want to see now when they're going to report. So let's go to August so you guys could also see, because this is going to give us a different result. Notice the at the money price is 263 for the calls, 315 for the puts. But when we go to August, you're now at 325 for the calls, 380. So it's about 50% more. It's a lot expensive because now we're saying the expected move, factoring in earnings, and then having additional time left. But again, this is where you could take advantage of options, but you all again don't forget you need the stock to move in your direction, because it doesn't matter if you're like, okay, wow, it's mispriced, or I think it's going to move beyond that price, that the market's pricing in. If that doesn't happen, you lose. But again, the opportunity is if it does move in that direction and even more, that's where you're able to make your gains. But again, you got to focus on the underlying. And now if you guys want tips for that, go look at past earnings, go factor in what the stock has done, how it's been moving, what catalysts are there. You could look at inside buys and sells, all that type of stuff. But do you see how if you're just looking at the chain, you're shit out of luck? If you're just looking at the stock and then buy a random option, you're shit out of luck. You need to combine and mix the two. So looking here for Twitter's earnings, on August, let's say they're called, the stock's at 43.85, so it's already 30 cents in the money. So I would subtract that from the call price, because even if I buy this at 325, I'm buying it with 30 cents of value. So I'm really getting it for 290. So doing that math now, 43.50 plus 290, the market is essentially pricing in that the stock is going to go to $46.40 on the upside. And then now for the downside, 43.50, it's out of the stocks, it's not in the money. So you could factor this 380 head on. 43.50 or no, excuse me, stock's at $44 minus $3.80. $40.20. So that's your range that it's going to. I forgot what I said on the upside. I think it was like 46 bucks on the high side, $40.20 on the low side. So now when we go to Twitter, let's take a look at Twitter. You could see, and now here's the thing also, you want to see what percentage that is, right? So now if we're looking, okay, 380, right, is what we're looking at. Take 380 times that, or divide that by the current price of the stock, $44, that's an 8% move. So when you think about it, that's actually a pretty big move that's getting priced in. Now that means either the option's expensive or people expect a lot of movement to occur. So when we're looking at that, it's expecting an 8% move on the downside to 40, which it doesn't seem that far away, but again, percentage wise, that's big. And then on the upside, 46. So it's kind of stuck in this range. But putting that together, what I think at the money, is that really a good deal? Not really. And now again, you would factor in the same thing on the rest of these options to say, is this a good deal? Is this a bad deal? Like, let's say you're going to go for some of these out of the money ones, the 47 one, you see volume on it, whatever. Remember, you're saying by August 17th, you're expecting the stock to go to 55.47. Because again, you're going to pay 47 for that contract, minus that by 44, you're left with 1147. Divide that by 44 bucks. You're expecting a 26% move for you to hit break even by August. So again, think about how my out of the money on Facebook netted me so much. Yeah, the stock did move 20%, but if I got 20% out of the money, I didn't make as much. I made a lot because I was 10% out of the money, and then it moved an additional 10%. So these options are kind of priced in there. And, I'll make this in another video talking about it. I think I will save that so you guys have to watch another one. I don't want to lose all you guys here in one because I know some people don't pay attention all the way through. But taking a look, right off the bat, I could even tell you, be careful of these Twitter options simply for, I could just see it stand out. Let's go back to 20 days. Maybe it'll look a lot better. I don't want a 1 minute. We want a daily. Take a look. These same contracts, today they went up. Yesterday they started at 20 cents. The day before that, you could have got them at a low of 20 cents. They closed around 26. You're now paying double. So again, that's an implied move happening. So you're kind of taking a lot more risk because again, now if that was a cheaper option and the stock was lower, it's not changing the fact the implied move. But again, even if you want to gamble on that, understand you're paying 100% more than a couple days ago. But go back to the understanding how to predict these prices or what the market's predicting. That's a really big move. So you have to understand what's implied. You're going to find the deals when the stocks aren't moving within a crazy range to get out of the money options, and it's not implying too much of a crazy move. So I'll leave you guys with that. This is very informational. Again, join the stock chat or the stock course so I can see you guys in the chat. I'll be in there during market. You guys have questions. We want to build a good community, and hopefully I get you guys all on the right path and spread the word. Love you guys. Stay in school.